What's up, guys? I'm Nobody Special, and we have a special guest with us today. David Morgan, the author of the Morgan Report, is with us. And David is also the author of the Silver Manifesto, which I have right here, David, as my signed copy that I got from you at the Silver Symposium back in 2022. Thank you for that.
Welcome.
And David, the reason I asked you to come on the show today is because we have seen some pretty unique things in the market especially since the trade war broke out, right? That's the biggest thing on everybody's mind. But silver has kind of lagged its other cousins in the metal space since this has happened. And you are the silver guru, as named on Twitter. So I wanted to pick your brain a little bit. Could you give us your thoughts on why silver has done this? Why is it behaving this way? And do you expect that to continue?
Well, first of all, Jack, thanks for asking me on your show. And silver's been quite a disappointment, really, because we've seen gold do so well over the last few months, and silver has increased in price, but not to the level. And we know that from the gold-silver ratio. I mean, the gold-silver ratio has been over 100 here recently, which means 100 ounces of silver buys 1 ounce of gold. Really, the high end of the band is like 80. And in fact, when I started the original website, the silverinvestor.com, and changed to the Morgan Report a few years later, 80 was when I started. And I really thought at that time you would never see a gold silver ratio above 80 from that point forward. And that was like 25 years ago. Obviously, I've been wrong, and of course, admitted it. And I never really put into print that I thought, 80 was the top, but that was just, me looking at the market for so long. So, will it continue? I don't think so. I think the main reason is that the run to gold started, and I've used that terminology about 2 years ago, and I based it on the fact that we were in a stealth move again, where the smart money, the big money, was moving into gold, and that was the central banks. They were buying gold, according to World Gold Council, well beyond their average over the last couple of years, and that continues to this day. To me, gold is the money of last resort, and it is an establishment metal or an establishment money, but you will never hear that on CNBC or MSNBC or any of the financial channels. You're not going to hear that gold is the money of last resort. But to the central banks, that's exactly what it is. And it's show me, don't tell me. All I have to do is look to see, follow the money. Well, the fiat's moving into gold more and more. It's been moving east for a very long time, particularly the Chinese, because they know how much they can trust a fiat currency, and they know how much they can trust the US Treasury market. Now, silver doesn't have that luxury. It's been demonetized in 1873. It's been really in the circulation up through 1964, as most Americans know if they pay attention to the precious metals. But it really hasn't been formally anything to do with the monetary system from the banking perspective. And because of that, sometimes it acts like an industrial metal only. Sometimes it has a monetary component. It still does, in my view, but it's lost its status. And the other thing I just want to interject, Jack, is that it's true of the white metals. I mean, basically, we see all metals move together. It kind of goes like the Dow theory. If gold is leading, that's fine, but you really want confirmation that platinum, palladium, and silver are confirming the move. Not that platinum or palladium are considered monetary metals at all, although classically they fit the definition. They're really not considered that. But silver has been, and silver has actually been the monetary metal of history. Believe it or not, Milton Friedman made that statement that at the New Orleans conference many, many years ago, the true monetary metal of history is silver, not gold. So the point is, until we get more buying, either through individuals or institutions in the silver market, you're not going to see it catch up. I believe that is going to happen. I think that gold is taking a pause here, and that you may see both platinum, maybe palladium, and silver. I don't know if I'd say catch up, but I'm actually looking for like a 71 gold ratio, which right now it's roughly 100. So that would be quite a move in silver relative to gold over the next, I think, several months.
So you mentioned a couple of things there that stuck out at me. You were talking about the central bank gold buying, obviously been a big thing for the last few years. And then you zeroed in on the gold to silver ratio, which is something I've been watching with great interest these past few days and weeks. Gold to silver ratio about 101 right now as of the making of this video. The last time we were down in this neighborhood on the GSR, March of 2020. And of course, that set up a rather impressive rally in silver. Both gold and silver rallied through most of the first half of 2020 into late summer that year. But silver tended to drastically outperform in that catch-up trade. Do you see any similarities in the setup now with this trade war versus what we saw in 2020 coming out of the vid? Or is this a totally different animal here this time around?
No, I think it's similar. I think I was lucky enough to catch that bottom or near bottom in 2020 and made a physical purchase that for me was rather significant. And I called it, and I did think it would shoot up. I think it got to, you could depend, the 125 is the round number. Got to roughly 100, which was phenomenally large on a gold silver ratio, but it snapped back rather quickly. This one, I'm going to go back to the 2011 top in silver and gold at that time. And I'm going to equate it to that, Jack. I think that in 2011, after we had the financial crisis where silver peaked, before the financial crisis, silver peaked at 21. And I forget gold's price, but they both came down. Silver, much greater percentage than gold, but they both fell off. And of course, the stock market and all other financial assets were going down. Silver bottomed around $9, and both gold and silver hit a spike low and then started up rather quickly. Silver went from roughly 9 up to almost 50, so it increased almost sixfold, 600%. And gold did about 300%. Now, my point is this: silver peaked the last day of April 2011, and gold didn't peak until September of that same year. I think we're going to see the reverse this time. Gold peaked in a few weeks back at 3,500. I think that's the peak, as I said, for a few months. And that silver may get to that 71. I'm picking out of the air. I don't have any super chart formula or anything else. It's just from all my experience that looks about right. And that could take both silver and platinum, as I said earlier, up relative to gold. So gold could go sideways and not really hurt anybody, be in a trading range of, say, 3,150 to 3,500 or so, maybe slightly above that to set up, not necessarily a bear trap, but get the gold bugs a little overexcited and then only to fall back again. So that's how I see it. I see, history doesn't repeat, it rhymes. So the rhyme this time may be gold definitely led. It had to pause, and then the white metals catch up.
So I'd like to talk a little bit about the silver supply deficit here because we are now 4 years into a pretty deep deficit where the economy has consumed far more silver than it has produced. And the Silver Institute is projecting another supply deficit for 2025, albeit a little bit of a smaller one. Now, built into that projection, there's some assumptions. Demand is supposed to be about 1.2 billion ounces this year. They're calling for an increase in industrial demand, an increase in investment demand, a little bit of a decrease in things like jewelry and silverware. Now, then on the supply side, they're saying, about 1.05 billion ounces. They see mining production increasing and recycling production increasing. So are you, based on what you've seen in all the various data channels that you follow, do you think we're still on pace for this projected supply deficit, which was written before Liberation Day and obviously the giant monkey wrench that was thrown into anything? Are you still on board with that deficit, or do you see any of those assumptions maybe need another look now?
No, I'm on board with them, not necessarily their numbers, but we never really know. I mean, you can look at the numbers that came from CPM Group and butt them up against what the Silver Institute does. And of course, Metals Focus is in the mix as well. And, they align fairly well. I mean, they're all in the same ballpark. I would say recycling, yeah, you might get a slight increase in recycling. As far as mining is concerned, that's doubtful to me. I'm certain that we've hit peak gold, unless we have a massive technology change that I don't know about. And I'm pretty certain now that we've hit peak silver, which means to mine that 1.05 billion ounces. First of all, that's the total silver market. It's not mining. Mining's about 850. 150 is a round number of what's recycled every year. So that's really tough because on aggregate, on the average, the mining uh, of the world's silver is going down in grade over and over and over again. It's a pretty steady trend. And so there may be a mine or two that have very high grade, but on aggregate, when you average it in, it does not build the overall grade. So you have to move more material, be it hard rock or dirt, or an open pit to get out the same ounces of silver, which means more energy. And so the idea is that I think their numbers are less favorable to the silver investor than they actually become at the end of 2025 and in April of 2026 or thereabouts where we're at right now. Jack will get the real numbers and say, oh, wait a minute, they overestimated the amount of mining that was going to take place this year.
So on that theme of mining, let's talk a little bit about energy, which is one of your biggest input costs when it comes to mining. On the supply side, as it pertains to precious metals, oil price, obviously, if it goes down, it makes the mines more profitable, could result in some additional supply. We've got OPEC Plus is largely believed to be about to increase production again by a rather substantial amount. It looks like there's been some geopolitical arrangements have been made where suddenly the Saudis are looking to pump more oil. So that translates into lower oil prices. We're down at oil prices we haven't seen since about April of 2021. And then, of course, the energy markets on the demand side of silver and precious metals, you've got things like EVs and solar panels that have added a lot of industrial demand to silver over the last few years. Well, EVs are slowing down. Some might call it a bubble. The Chinese are still building a lot of EVs, though. And then with solar demand, some people are saying that Europe has just had their Fukushima moment with their solar panels because of the big blackout that we had in Spain and Portugal. So any of these dynamics at play in the energy market, do you see any of them having an outsized effect on what the price of silver might do?
I do. First of all, the price of silver has pretty much paralleled the cost of production for years. I mean, there's a few exceptions, like the one I gave about 2011, but overall, gold as well, although gold has broken away the last several months, where gold has reached the all-in sustaining costs on gold mines anywhere from, depends on the mine, 1400, 1500. It could even argue 1600 in some cases. So you're looking at a double from that basically. So the margins in these gold producers is phenomenal. Whereas silver, it's really not that big, and it's not really much profit because the profit that you do yield has to go back into new discoveries. So on the aggregate, it's really tough to be in the silver business right now. As far as oil is concerned, everything you said, I agree with. In fact, I just wrote the report. It just got published yesterday, and pretty much what you just outlined. However, there is a subset to that, and that's diesel. And diesel is becoming more difficult and more expensive. I don't know, how many of our viewers drive diesel trucks or diesel cars, but you may be noticing a gap between gas prices at the gas station where you can pump both gasoline or diesel, that the spread is widening. That's because there's a bit of a diesel problem. To answer the question, it goes very, very strongly with the cost of energy. And that means we're in a sweet spot right now. It'll probably continue for some time, but diesel, again, is a little different than gas. And so you got to kind of think about that somewhat. If we ever get back up into an oil squeeze, which could happen with the Middle East problems and everything else that's going on globally, then you could basically have a big shift rather rapidly in the cost of production for the precious metals. So I think we want to keep that in mind. And a way to hedge that is to buy into some energy companies. Or of course you can use futures, which I don't recommend for anyone, but there are ways to do it. But I'm a little concerned about this Goldilocks three bears, and we're in that perfect place, perfect temperature. Everything's right for the mining industry just now. Whereas don't settle into that thinking for too long. It could change rather rapidly.
That's interesting. That's almost to suggest maybe a little bit of complacency starting to work its way in among mining investors. Is that what you're saying there?
I think so. I mean, the true values are in the gold producers. I mean, these things are selling for the same stock price that they sold out when gold was at 2,000, 2,500 the ounce. And gold's almost $1,000 higher. So if you want to catch the people that bought gold at 2,000, buy the underlying top tier cash rich mining shares, because that's what you're buying gold for. And I do think that they'll catch up. You have Drunken Miller and a few other notables in the Wall Street crowd that actually see the value in these gold stocks and have taken advantage of it. It's very few. And I think that is going to happen. It could be interesting to watch not so much the gold silver ratio we already talked about, but the gold to gold stock ratio. And you might see that actually change even if gold goes sideways, because the real value is in the mining, some of them.
So something else that's started to change recently has been safe haven demand, or at least the definition of what is and isn't a safe haven. Again, that monkey wrench of tariffs that's been thrown into everything. Since Liberation Day, since the trade war started, we've seen gold obviously has rallied on that safe haven demand. We've seen bonds sell off a little bit. That's been interesting. Maybe a little bit of that de-dollarization trade that some of the BRICS guys have been talking about for years. And then we've seen some things that didn't really make a lot of sense at all. We saw Bitcoin start to behave somewhat like a safe haven, rallying as bonds sold off and gold rallied. And then there's silver sitting on the sidelines. Obviously, you've already addressed the industrial side of the demand for silver. And so silver sat out that rally. Do you see any scenario where silver might start behaving like a safe haven? Like I view it as a safe haven, although it certainly hasn't behaved like one price-wise over the last few months. Is there anything that might make that change, or is silver just at the whims of its industrial demand for now?
Oh no, it can shift quite easily. I mean, it's, can almost be a fad or a meme, because as I said earlier, silver is the money of the world from a perspective of monetary history, much more so than gold. And the other thing is what's changed in the world. And one is China. China's Shanghai Gold Exchange is certainly using silver in the mix much more than it was back when I visited China back in the early 2000s. I mean, I was in Beijing and the outskirts. I was there for almost 2 weeks, visiting different mining projects, meeting with the mining bureau, meeting with some of the bankers. And I tried to find silver to buy just as an exercise. I usually do that whenever I visit a foreign country, and particularly China, because I didn't know if I'd ever get back there, and by that, I probably never will. And the only thing I could find in Beijing, it was on all of Beijing, I didn't have a lot of free time, was some sterling silver chopsticks. I mean, there was not a coin shop anywhere to be found. And I asked, and I had pretty good connections. Now the Chinese are actually buying silver as a safe haven. And the Chinese, by the way, were the last to go off the silver standard. And then you could go in the opium wars and all that, which I won't go into. So, Jack, I sent you a graphic a little earlier. I think it might be a good time to put that up, which basically shows all of the silver demand. It shows the industrial demand, it shows the mining and recycling, and it shows investment demand as well. And what you can see from this chart is based on the years at the bottom, going out for the next 25 years, it looks like we're going to be in a structural deficit for silver, meaning that all of the mining and all the recycling, which is the red line that goes from left to right, goes slightly to the downside because the grades keep going down, as I said earlier. So if we have hit peak silver, you would expect that mining and recycling would roughly stay around 1 billion ounces per year. Everything above that line in the last couple of years, it has to be eaten from above ground stockpiles. What I find about this chart, which was done by Matt Watson, who's an independent mining metals analyst, is what he assumed for these next 25 years on the investment side. So the gray or the silver bars at the top are investment demand, which he has, gauging it from the scales, roughly 200 million ounces a year, which is the average it's been for the last few years from retail demand only. That's really without any institutional demand. The graph is wrong, and not to pick at Matt, but in 2020, that silver line, that should have been well above the where it's shown because the overall investment demand in 2021, bought in 2020, it show up in the 2021 year, was 520 million ounces of silver. 200 million, you're pretty much standard for the retail investor stacking coins and bars. But industrial demand was 320 million ounces. So if you add the two, you come out with 520 million ounces. So my point, Jack, is that as this becomes a safe haven more and more and more of those that projection will actually increase. Now, this is his low case, and his high case does show more of what I'm alluding to, that there could be an increase. So two things that I want to emphasize. One, it is the money of last resort. And secondly, being at my age, watching what happened in the last manic phase of the precious metals market, when really it was a US market with a few Saudis that jumped on the hunt bandwagon near the end. And that was silver ran at the last final moment because gold had become so expensive for the average investor that they seek safety that they shifted from being able to buy gold into the silver market. But that was a US phenomena. And at that time, going from 1971 to 1980, as an example, 10-year bull market, say as a 15, depends how you measure it. Most people that were adults, remembered seeing silver in their coinage. They felt it was something there. And that's when I wrote the 10 rules of silver investing so many years ago. I said that no one wants to be a prophet of doom. But in the unlikely event that there's an all out financial failure, silver will become the metal of last resort, not gold, because gold would have too high a unit price to be able to buy everyday goods and services like silver would be able to buy gasoline, food, etc. And that still holds to this day. Think about it. So, not saying that we're going to have it, not saying we need silver to barter with, but as I said, the unlikely event of an all out financial collapse. And then I went on to say in that rule number one of 10 rules of silver investing, because of this possibility, everyone or every investor should have some silver on hand for emergency purposes. And I did a thought study on that one time that if just the American public bought 2 ounces of silver, we basically run the mining supply out because there's that little mine. 350 million Americans times two's like 700 million. We mine about 850. So say 3 ounces would wipe it out. So when the run to gold continues and gets too high, I think there'll be a shift into silver. I think there'll be institutions that will maybe on the QT. I mean, I have to digress a bit, Jack, and that 320 million ounce purchase, in my opinion, all of it, probably not, but the lion's share of it, probably, again, my conjecture, came from Guggenheim Investments, where Scott Maynard was on an interview at Davos, better known as the WEF in 2020, and the Bloomberg analysts were drilling him on what was his go-to investment in 2020. And he said silver, and they almost fell off their chairs. One guy almost swallowed the microphone. I couldn't believe a guy would say silver, in a forum like that. And the gentleman asked him, well, why silver, not gold? And he said, because gold is pretty near its high, and silver is 40% undervalued relative to its recent high. Therefore, it's a better value. So I said a lot, and you can unpack it, but I really do think this chart shows you, no matter what you think about the silver market, and if you look at the green bars there, for example, he's showing solar going out the next 25 years and actually not growing, but actually tapering off somewhat. Now, the yellow there is the EV market, which I think he's pretty conservative on. And then, of course, the jewelry market's pretty steady Eddie. And last time gold got, I won't say overpriced, but so high priced, people will still actually buy more silver jewelry now. Will that happen this time or not? I'm not going to make that argument. My argument is that jewelry actually is pretty benign relative to demand and price. So really the big variable there is investment or monetary or safe haven demand. And my argument is it's going to increase, and it could increase substantially depending on, let's say, some bond market failures where the treasury goes out there, the money center banks are buying up what they need to, the foreign investors saying, we've had enough of this funding money for so long. These paper promises mean absolutely nothing. Eat it on your own, and the Fed has to come in and start monetizing more than they ever have.
One thing I never gave much thought to until you just mentioned it when you brought up the Shanghai Gold Exchange. And we'll mention China, and by extension, India, I think falls into this as
Oh,
well.
yeah. I should have mentioned. Thank you, Jack. Sorry to interrupt. Yes, you're right.
The average Chinese household has about 90% of its net worth in housing right now, or in real estate. Now, that's a few-year-old statistic that may have changed because of the real estate collapse. But as of about 2022, 90% of the average household wealth was in real estate in China, versus in the United States, you have a pretty even 1/3 each to housing, bonds, and stocks, right? You've got the average person has some equity in their home, and then a 60-40 portfolio. Roughly about a third of the average middle class net worth is in housing, bonds, and stocks. Now, in China, there's not much trust of the stock market. It's not as popular as it is here in the States. And you've got 1.4 billion people that are no longer willing to put their money in the same place they've been putting it for 30 years. And those people are watching their wealth go up in smoke. It's natural to believe a lot of that money is going to seek safe haven demand. And so I see the gray bar here, the investment demand staying relatively constant. I think China alone is enough to show considerable growth in that bar over the next 20 years. And then on top of that, if you add into it India, which I think most people would consider India is probably very well positioned to benefit from the trade war between East and West. Well, if you have per capita wealth growth in India, who's already very predispositioned towards precious metals, I think you're talking almost half of the world's population there suddenly having either a lot more money or a lot more appetite for safe havens. I think the growth in the investment demand over the next few years here is very conservative. Let's put it that way.
Well, that's my point, and thanks for reiterating it and doing a better job really bringing India into the mix. If you go back when I started, on the web, very few Indians bought gold because they were so poor. But like the Chinese over the last 2.5 decades, the last 25 years, the standard of living in both those countries has increased immensely. And I'm happy for them. And because of that increased purchasing power, they're able to buy gold, because gold is more or less the preference in both those countries. Nonetheless, that doesn't mean the demand, especially in India, is for silver, and it's reignited in China. In fact, before the show, Jack, I got a hold of the Ghost on Twitter. I won't mispronounce his name, but he's been fairly friendly to me and answered all my questions up until this point. So I was trying to get an update from him before our communique today, and unfortunately, he hasn't answered me yet. He probably will, but he did in the last correspondence relative to the Chinese appetite for the average person in the silver market. He told me in writing, not that one data point makes everything, we're both engineers, but the indication was the demand for silver at that time, and that wasn't that long ago, in China by the average person was more significant than it had been in a long time. That was almost his exact words to me. So I'm just backing up what you just said. I think that chart's wrong. I think that people are going to say gold's, 3,500 the ounce. That's half of what I have in my savings account. I see the destruction of the dollar. I need to put it into something. I got enough tuna fish. I want to get a monetary asset. I'll buy silver, not gold. Look, the ratio is 90 to 1 now. It was 100 to 1. Looks like it's starting to move in my favor.
I couldn't help but notice I've got enough tuna fish in there. That's in the natural hierarchy of things. Yes, tuna fish ranks very high. All right. So on a more serious note here, you said something in a recent video on your YouTube channel, which, by the way, I'll put a link to down in the description below. You did a short video it was either yesterday or 2 days ago, talking about platinum. And you zeroed in on platinum. You said that could be, I'm quoting you here, could be the single most asymmetric bet in the metal space right now. What makes you zero in on platinum?
Well, first of all, I'm talking my own book. So just to be, on the up and up, I've been accumulating platinum for more than a year now. And basically, it's done nothing but go sideways. But I think, especially for someone that's maybe, retirement age or something, platinum is a safer bet than probably any of the metals because you're buying it for under the cost of production. And the reason it's an asymmetric trade is a couple things. Number one is it costs about $1,200 to mine an ounce of platinum. You're buying it for under 1,000. Second point is that 70% comes from South Africa. And they have issues in South Africa politically and energy wise. So there's a possibility, and I'm not wanting this to happen or even forecasting that it is going to happen, but it could happen where there are delays in getting platinum above ground. Mining platinum is extremely difficult. It's 15 times rarer than gold. It used to always carry a premium above gold up until the last probably decade. I have to look at a chart. It's been a long time that gold has actually held a premium over platinum, but up until recent history, that wasn't the case. And lastly, Russia has been buying silver, platinum, and holding their palladium as a strategic asset, and they are not finishing purchasing yet. So I think there's so many factors favorable to platinum as far as a very low risk. And the asymmetric trade is kind of the, the potential for investment demand, or maybe someone that's late to the gold party really wants gold, but says, you know what, this thing's 15 times rarer than gold. Doesn't look like much downside risk. Gold could maybe get under 3,000 again. I'll buy platinum. I don't think I have much risk to the downside other than maybe $50, but a lot of upside. So there's a lot of reasons could be asymmetric. Let me finish the last thought, which is hydrogen economy and what platinum is used as a catalyst could, I say could, not would, become more and more valuable from that aspect of cold fusion and these other things that are out there in the marketplace that some people poo-poo and some people study hard and realize that this is a very important element on the periodic chart or perhaps part of the new energy future. So there's a lot of things lining up. And if that were to occur or something like that that I haven't thought of yet or don't know about, all of a sudden platinum's scarcity, that's a need, becomes very, very critical to its price direction.
So if we're talking platinum, I'd be remiss if I didn't ask you about automotive, because that's obviously the main source of demand for platinum is in the auto space. Now, tariffs recently came out. Again, the trade war is the biggest thing in finance right now. Bullion was exempted, which included gold, silver, and the PGM metals. So platinum exempt from tariffs, but automotive still has 25% tariffs put on cars coming in and parts from other countries. Do you have any concern about slowdowns in automotive production or maybe the tariffs causing problems on the demand side for platinum? Or do you think that, I mean, that $1,200 cost number was pretty powerful, right? That's a pretty big deficit that the miners are operating at. Do you think that trumps any kind of demand concerns in the auto space?
Yes, I do. But to further that argument somewhat, um, first of all, the EV thing may have been overblown for a while. I don't know for sure. China's certainly on board with it. But I want to tell you a story about the number one point also is that platinum and palladium are interchangeable in diesel or gas. The misnomer that you can only use one for diesel and the other for gas is incorrect. I don't know how it got out there, but it's not true. Back in the early 2000s, Ford Motor Company saw platinum at a very high price and palladium a very cheap price relative to platinum. So the logistics department, the engineers, the management decided to switch the supply line from platinum into catalytic converters to palladium. It was cheaper. It's going to save them a bunch of money. Not knowing how small those markets were, Ford ordered physical platinum. This shows you how quickly physical market can take over the paper market. So what happened was palladium went sky high. You can look it up on an old chart. And what happened was they basically couldn't supply Ford with all the I keep saying platinum, palladium that was required that they had ordered. And what happened at the top of the market was that the paper price of palladium was double the cash price of palladium. That's how absurd it got to be. And the LME at the time decided that they, who had it in storage, would dictate who was able to lease it and who was able to get the physical as required. Now, it was a temporary thing. It didn't last very long, kind of similar to what happened in the nickel market a few years ago. But that shows you, number one, that the physical will always trump the paper market. And secondly, how absurd it could get because of the amount that's required for the catalytic converters at that time. Now, EVs weren't even around back then. But my point, Jack, is that these are very small markets, can move very quickly depending on them.
And a lot of fuss is made over the paper to physical ratio in the gold and silver space. Correct me if I'm wrong, but the PGM metals are far more volatile when it comes to the amount of paper that's traded versus the amount of physical that actually changes hands, and therefore more susceptible to those violent swings that you just described. Is that accurate?
It is. I was actually long palladium at the time. And of course, it made this big jump up. So I thought, yeah, I got the couple on. I'll add one or two more. I've got all this cash in my, margin account. And so when my broker called me before I could call them, he said, you got to put up more margin. I said, what do you mean? I'm long. And that's when I learned for the first time, I was quite young at those days, that, or much younger anyway, that margin requirements could go depending either side. Didn't matter what side you're on, long or short, the margin requirements. So they basically forced all the little guys, such as myself, to abandon their long positions. And this has happened over and over in the futures markets. Not only been palladium, platinum, gold, silver, it's been in oil, it's been in the foodstuffs. Basically, the commodities exchange is just that, it's an exchange. It's basically a bunch of guys that run it, some women too, of course, but it's basically their rules. And their rules are they could change the rules if they need to change the rules.
Yeah, and we saw something very similar with the silver squeeze movement. You'd think a margin call isn't the kind of call you'd get when the trade is going your way, but
Right.
in these metal trades, sometimes when they go your way too much, the margin man calls anyway for selling. Absolutely. All right, so I want to ask you a couple more things I wanted to talk about. The Fed, obviously, anytime we're talking about metals, the Fed is going to come up. The Fed put has always been this belief that no matter what happens, number go up, because the second the market starts to go down, the Fed will print money, lower interest rates, ride to the rescue. Zerpenber, as I often call it. But right now, in the political landscape, we seem to have something of a game of chicken going on between the Federal Reserve and the Trump administration, whereas the president is being very vocal. Once again, he wants his rate cuts, saying things in his typical flamboyant style directed at the Fed chairman. And the Fed now is saying, no, after years of monetary debasement, suddenly we're so concerned about inflation that we're not going to cut rates here. Do you think where do you see this going? Will the Fed blink? Will the Trump administration blink? Will we get this return to Zerpenber? And what does that mean for metals?
Well, that's the last part first. I mean, if the interest rates go the way the Trump administration wants, that'll reignite a fire under the precious metals. However, I think it is a game of chicken, as you outlined. I think they're both in 1950s Fords, and they're both floored, and they're going about 90 miles an hour head on. Neither one is swerved off yet. I think Powell's playing a somewhat Volcker move here, where he's not going to lower interest rates. It is an independent agency, or primarily that, and force the dollar to remain significant relative to all the other world currencies, which means that you're not going to get a huge move into inflationary hedges or debasement hedges. And therefore, I think it's a standoff. And I really think we've got to watch the next few auctions to see what happens and how much the Fed has got to eat the amount of issuance that is not readily eaten up by the market. And that could force interest rates even higher, because as much as everyone thinks the Fed runs everything, they really don't. I mean, they do have a great deal of power. That's indisputable. But the amount of power isn't all encompassing as most people think, because the market itself could actually push interest rates even higher if there were not enough suckers to take the debt of the United States at the quantities that are required to keep funding the rollover that's needed, which is what, 11 trillion this year. So we're past the end of the road. Talking about kicking the can down the road, we're there. We've been there, and we've actually passed it. So now it's who's going to stare down who. I'm actually voting for Powell for a little longer. I don't know exactly. I don't have a hotline to the Fed or to the administration, but I am a pretty good student of the markets. And I think this could get to a position where, as I said in an earlier interview, this could be a planned destruction where things really start to unravel more rapidly. The tariff thing is not a misnomer, but it's just the catalyst that was required to take us into the new financial system.
So that leads me to my last question, which is going to be a little more high level macro. You mentioned the Federal Reserve, and you mentioned maybe running out of people or suckers, as you put it, to buy our debt. Right? You've got the twin deficits in the United States. You've got our massive trade deficit, where we buy way more stuff than we export. So really, we're exporting a lot of dollars. We're exporting a lot of inflation. And then the other deficit of the twin deficit is our government's fiscal deficit, runaway government budgets. Now, the only reason that we've been able to get away with one is because of the other, right? Without other countries having an excess of dollars because of all the trade that they conduct with the United States, they wouldn't have all those dollars to reinvest or to lend back to the United States so that we can keep running those government deficits, right? If you have a trade surplus with the US, you've got extra dollars. Why not park them in United States treasuries, loan them to the government? They'll spend it back into the economy to drive more consumption, rinse, repeat. Well, on Liberation Day, Trump held up his placards in the Oval or the Rose Garden, and we realized they quickly reverse engineered the math and realized what Trump was trying to do was get rid of the trade deficit. They said it was currency manipulation and other barriers, which was really, they were just backfitting what the trade deficit is between the countries. So if the goal here is really to zero out the trade deficit with the United States, well, then these other countries aren't going to have the money to reinvest back into the United States or to loan back to the US to buy treasuries. So if we win the trade war, and nobody really wins a trade war, we're basically cutting off the bond market from one of its biggest sources of liquidity. In which case, the only way we could possibly survive that would be massive cuts to government spending. We'd have to get rid of the other twin of the twin deficits, the fiscal deficit. Well, we just went through this ridiculous exercise with Doge and government efficiency, and we fought over government spending, and the judges interjected and said, no, you can't do that. After all of that hoopla, we didn't cut spending at all. The deficit is projected to continue at 2024 levels throughout this year, probably go even higher than that. So I guess where I'm going with this at the end of the day, is there really any hope that this government spending is going to come down? And if it doesn't come down and the trade war goes the way we hope it does, doesn't that just guarantee the Fed will at some point turn the printer back on? And in which case you have to own metals if that happens. Or am I maybe
No,
taking
you outlined it very well, and it's print or die, and they're not going to die; they're going to print. In fact, the latest publication, my personal work, and I have a team, is I bring it up in front of me, but I just wrote it. It's basically in my head, Jack. But basically, the whole premise of the editorial this month was: are we going to go into a hyperinflationary blowout, or are we going to go in more of a debt liquidating stagflation? And that's the argument. I talked about it and which way it's going currently, which is more toward the latter. And that's why I think gold has hit a peak for a while. But the ultimate thing is probably, I even hate to use the word hyperinflation because I don't think the US dollar will hyperinflate, but I think inflation will get high enough that for all practical purposes it is. And what I mean by that is that these, bond auctions just don't take place. The Fed's got to monetize it. There's a run to gold, and then there's a new Bretton Woods, and there is a reset in the market that, okay, the dollar cannot be the standard any longer. It's got to be make up a new word, the CBDC, which could easily be a private CBDC. It's the JPM digital dollar reinvented or whatever. So it's very precarious times. And I think the only way out that I know of that I think that they're going to do, being studied on the topic, my last speech at the New Orleans Gold Show was the new monetary system, and all of it came straight off the BIS website. So the bankers are one step ahead, you might say, of what they want. Whether they're able to implement it effectively, efficiently, and with the turn of a switch, and that remains to be determined. but I think they're prepared for the demise of the currency realm and move into this digital only, real ID, no cash system. And China's already there. I mean, China really is the beta test for the world, and it works quite well in China. If you're one of the 400, 500 million that lives in the city, or maybe more than that, I don't know the exact percentage, it is a cashless society. Everything's done with Tencent or WeChat. Everything's done with facial recognition, and the people are used to it. I mean, some probably free thinkers, free market thinkers probably don't like it, but they know better than to say anything because their social credit score goes down and they can't buy what they want or travel as they wish to or get the hotel they want to stay in. So that's what I see, Jack. It isn't a very pleasant story. I could be wrong, and there certainly could be some pushback, but I'm pretty certain that's the direction we're moving.
Pretty grisly scenario you're painting there, right? This, especially the social credit score, and a lot of people, self-included, believe that the central bank digital currency is a step down that road. At that point, you're basically talking about financializing compliance, where doing what the elites tell you to do becomes a currency, and it's the ultimate form of control. And I do think you have a very strong resistance to that in the United States. Slightly less in Europe, and none at all in Asia. So the world does seem to be heading in that direction. Hopefully that stops. Anything else, David, before we wrap up here? Anything that you're watching, any stories you see kind of lurking beneath the radar that you think people need to be aware of, or any parting words of wisdom you'd like to share with us?
Yeah, Jack, I've made or making a documentary. It's at silversunrise.tv, and it talks about the control and fear of money. It's taking money kind of at a spiritual wavelength and showing about how much control it has now. And then what I just outlined and you confirmed, it looks like the push is to make it even more of a control mechanism. And this movie is more about what the real power is us, we the people, and to re-engage with that power. Money's important, but it's not the only thing. Our personal sovereignty is very important, and we really do have the power. We just have to unite, not in the sense of, if you're red team or blue team or any of that stuff, which I really don't believe in, but as a humanity. And so that's the gist of the documentary. It talks a lot about energy, and energy is really the solution, not money. And if we're able to get an energy source that is near free for everyone, and we're able to take the oil cartels worldwide off our backs and start getting enough energy, and I'm not talking about sustainable like solar and wind, which I'm not against, but I'm not for either as an engineer. I'll just say that for the record. But something along what you and I are supposed to never talk about, which is like a free energy from the ether, some of these proposals, like I talked about earlier about the platinum group metals perhaps producing cold fusion and that type of thing. So that's part of the movie. So it's to give hope to people that it's not over till it's over. We have the power. So thanks for letting me say the last final words there, Jack, because my life's work is not really about sound money and honest money. And that's certainly a subset. But I teach more than honest and sound money. I want us to talk about freedom. And without freedom, it doesn't matter how much gold or silver you stacked. You've lost everything if you've lost your freedom.
Fantastic words to end on, David. Thank you so much for your time, for talking to us on the weekend here. Folks, once again, that is David Morgan, the author of The Morgan Report, as well as the Silver Manifesto, flashing my signed copy once again. And really looking forward to Silver Sunrise TV. I didn't know about that, so really looking forward to that. Definitely let me know when that is done. And well, thanks again, David. I appreciate your time. Everybody else, until next time, live small and dream big.